Welcome back to Golden Rule Radio. I'm back, guys. How are you? Miles, Tori?
Glad to have you back, Robert.
Welcome
Long
back,
time
Gooden.
no here.
It seems like it's been a while and haven't been able to actually rub shoulders with you in a while. I've been at home, as some people should be, all the time.
Yeah, do you feel like you've missed anything market-wise?
Definitely feel disconnected, but the markets have definitely provided some activity in our office, I'd say.
Yeah, I definitely agree with you. I mean, the way certainly our precious metals markets have been going, gold specifically, and we'll look at the gold chart here in a second. Obviously, across the board with the COVID-19 shutdown of everything, just the responses that we've seen over the stock market. So welcome back again, Robert, and with everything going on in the markets, it's good to have King Dollar back in his recording booth chair. So looking forward to, with the stimulus checks coming out this week and another massive government intervention, obviously the inflationary concerns that we have, and Tori and I talked about inflation versus deflation last week. So be good to get your take on what you think the dollar's doing. But obviously, as we tend to do, perhaps we shall kick it off with where gold is this week.
Yeah, well, it's good to be back. It seems like every time that I've been on the show in the last 6 months, I've been talking about, oh, here comes a little pullback in your opportunity. And I think that was the last time I was on the show. It was about a month ago when we had that pullback down to, what, 1450 on gold? Bounced right off of 1450, which was kind of our target. And now gold is above 1700 to a new high, not an all-time high, but to a new 6 or 7 year high, pushed all the way to what, 1750, and holding nicely above 1700.
Definitely strong. I mean, it's been not just strong in terms of the spot price, which in itself is hard to track because you don't know which one to follow, right? You've got the June futures markets that we talked about last week. You've got GLD that you can track. You've got some of these other fundamentals that drive a variability in the spot price that we're seeing right now. So we saw gold as high as 1767, and yet on some indicators the spot price was only around that 1740 level. So be careful about that. What spot price are you looking at that's serving as the basis for anything that you're buying in the physical market? But that's one thing. Price action is one thing. Another thing is physical demand. And again, we're setting unprecedented highs in terms of our company's physical business. And that's just because people realize, look, first and foremost, you got to try to have it in hand. Secondly, you got to try to get your IRA into something physical, tangible, that provides a good hedge or good diversification on a portfolio. So you're right, Robert. Ton of activity, not just gold, but silver as well.
Looking at where the price came in yesterday, as you're talking about pushing back up into the 1700s, you know, last week we pointed out a couple things on the chart and had this sort of ceiling of failure back in 2012. After we broke 1900, we made those multiple attempts to push back up and just kept failing. And that kind of ended up being our after high ceiling right around 1800. So if you look at those top ranges, you had this $100 or so range, $7,500 range up and down that we broke into a couple times. So we hit that for the first time since 2012. So congratulations to gold. You've now come into the second place all-time high numbers at around 1750, 1760, like you said, depending on who's putting the data out and which software you're getting your spot price data from. So I wouldn't be surprised to see gold find a bit of a ceiling here short term, possibly even turn around and come back down a little bit, but I would guess not much. You know, there's really not much between here and that all-time high above 1900 slowing us down except for these three little attempts to push back up and retry it back in the end of 2011 and then through 2012. So 9% away, guys, 9% away from the all-time high, and you're still not hearing anybody talk about it, which tells me the last all-time high is not going to be the next all-time high.
I totally agree. And yeah, we talked about that as a staff yesterday too. People think, oh, you know, and remember, this price action is not based on headlines. You're going to get headlines about gold when gold is at an all-time high. And like you said, we came within 9% of that. Or when gold crosses $2,000 an ounce, now you're going to get headlines and you're going to start having a herd mentality of people all of a sudden having a fear of missing out and jumping into the gold price. And that's where you're going to quickly shoot to 2,100, 2,200, even if it doesn't happen by the end of this year. I do think it will within the next year. So a lot of this price action, again, is based just on the fundamentals. And we'll get into the fundamentals later in the show. But from a technical standpoint here, we also talked about the fact that it had really overshot some of the short-term moving averages. And when you overshoot that far, what goes up tends to come down. And so it's not a surprise that it's pulled back for a breather here today. You don't want it going straight up. That's not healthy. Eventually, it's going to come down and touch some of those averages or those key support levels that you point out, Miles. And those are our new entry points. Robert, the way you started the show is, hey, where are the new entry points? And when you're in a climbing bull market like this, you've got to take those opportunities.
Well, and I'll jump out on a limb and give you one if you guys like it. I'm going to say 1565. If we get a turnaround here, I'd be looking for gold to come down as far as the mid 1500s, which sounds like a lot. That's a $200 drop off the high. But arguably, when you're talking about pricing up as high as they are, you can't really think in terms of dollars anymore. You have to think in terms of percentages. So where I get this number from, if you look at the start of this rise back on March 16th after we had the big fall, and let's pretend we ended yesterday, which we'll know over the next couple days if that was an interim high we put in. If we come back down to around 1565, you're looking at two things here. You're looking at the 618 Fibonacci correction back down, which is also lining up with an upside down head and shoulders, where you've got the left shoulder back on about February 28th, also at 1565. So you guys can see this on the chart here, but I think that would be a spectacular turnaround point that would fit up with a few different technical indicators. And at that point, by the time it were to get back down there, that 50-day moving average on gold would have probably also turned back down and matched up around there too. So anytime you've got multiple indicators that are all lining up or likely to line up at the same price point around the same time, that starts to add a little credence to the argument for me. And if gold turns back down here, which it possibly could after we came into that ceiling I just talked about a second ago, that would be my targeted entry point on adding to gold positions.
That's good stuff, Miles. I'm assuming you'll put that on the charts here for people to see. I want to make a point when we're talking about pullbacks here, is that the last few pullbacks with gold have not given you much time to do anything. So if we do see something like that, could be very short-lived, like we saw in the last few. That first touch into the 1565 after we had gone up to above 1680, that second drop into the 1450 range. I mean, it bounced off of 1450 and only played around 1500 and maybe just below it for a few days. Didn't even hardly give you time to wire funds and actually place an order. So if you are ready to look at adding to a position in gold, or if you're trying to create a new position, then I would be ready to send funds or go ahead and send funds so that you have the ability to maneuver and actually execute if we get some kind of pullback like what you're talking about, Miles.
Yeah, last week, Miles, you were really bullish, and I appreciated you stepping out. I mean, you were really calling for that 1750 to be breached, and it was. This week to hear you, not from a macro cycle, but from a micro cyclical bearish attitude. Really, even if you go down to that 50-day moving average, you're still $100 lower than where we are now in the low 1615 or so. And so, Robert, you're right. You may not be awake for it to go lower than that to Miles' entry point, right? It might happen in the Asian market. It might happen in the London market and have it reverse right off of that. So if you even see it come down to $100, that's an absolute no-brainer. And as you guys have said in the past, using the term back up the truck, there's Robert's back up the truck moment.
I will add to that as well, Tori. That's good. Miles's call last week was brilliant. I thought with gold headed higher, it was ready to do so. And hopefully you guys are actually following us with what we're talking about, because we have been fairly accurate when we make a call like that. I want to illustrate something that I pulled up again here, because I used this as a reference to a client about 3 weeks ago. Pulling up the usdebtclock.org website has a bunch of numbers that are running. And has anybody noticed that the U.S. debt actually breached 24 trillion.
And counting.
That's not the point of why I'm bringing that up, right, and counting. So if you want to check that website out, it's actually pretty neat. But what I had illustrated to a client only about 3 weeks ago was the dollar to gold ratio. If you scroll to the right on that main usdebtclock.org website and scroll to the right, check it out on the right-hand side, and about halfway down, it has dollar to oil ratio, dollar to silver ratio, and dollar to gold. Well, the dollar to gold ratio about 3 weeks ago was $16,000 an ounce. Today, anybody want to take a stab with new few trillion dollars of debt? It's almost 20,000. It's 19,660 as I speak. The dollar to silver ratio is $2,372 an ounce. So I think we may not go all the way there. I think we could, just because of how many dollars have been created. But it's obvious to me, gold, silver, platinum, the whole precious metals universe is headed higher.
Yeah, I agree. And I'm glad that you've kind of segued into some of the underlying fundamentals. This is where I'm going to sort of get on a soapbox for a minute. So I apologize.
Underhand soft toss for you.
Yeah.
Tori.
There you go. You know, the fact of the matter is this debt is scary. You say it's kind of a neat website, and it's also kind of a sickening website because that's the reality of it. The Congressional Budget Office predicted $1 trillion deficit this year prior to all of this occurring, which means prior to the spending that's gone on and prior to the lost revenue as a result of economic contraction, right? So now you're going to be looking at that number a year from now, likely above 28 trillion. Just a year from now. That's just the reality of things. And that's a Ponzi scheme, right? I mean, what happens in your guys' households if you just create more debt to pay off your debt? You go open up new lines of credit. Pretty soon, banks and those that extend lines of credit are going to start ignoring you. They're going to lower your credit rating. Well, what's going to happen to the U.S. credit rating here? You know, and our spending is just accelerating. And this is going to be a global event. This is where Keynesian economics kind of rules the roost. But the Fed just came out, all right, we're going to spend another $500 billion the U.S. government's talking about to help lend more money to small businesses, right, or give more money to small businesses. But Bank of Japan is already extremely concerned. They won't even talk about inflation or GDP. Bank of England, they're extending their ways and means, which means that they're just funding the government operations. You know, there's a blank check there. Well, the Federal Reserve this week came in, and now they're saying that they're going to open up a $2.3 trillion lending program. And this is scary because we just federalized our markets, right? This is going to be called the Secondary Market Corporate Credit Facility. And you can buy U.S. listed ETFs and junk bonds and munis and extend various loans through this thing. And that's directly from the Federal Reserve, which is money printing and injecting into the system. So now we're approaching almost $10 trillion money printing impact on the U.S. dollar. That's just the U.S. dollar. Okay. And on top of all this, we talked about the revenues decreasing. Employment. Now the U.S. initial jobless claims hit 6 million. 5 million was expected. And that means 16.8 million Americans have lost their jobs in the past 3 weeks. That's 11.5% of the labor force. So what happens to our GDP? What happens now as we start to see revenues, tax revenues plummet? That's where the deficit really widens.
Well, and Tori, I think that harkens back to our conversation last week. I mean, the value of the U.S. dollar, the difference between inflation and deflation. We have an opinion on that. We think it's a supply issue, not a demand issue, and we think inflation is caused by the Federal Reserve, period. So this is why it's good to have the dollar discussion intermixed here, because with this rampant rush to liquidity, the dollars getting printed still have a buyer on the other side. So the issue happens when all of that additional money out in the system ends up affecting pricing down the road. So the scary thing about inflation is you don't really see the effect for 6, 9, 12 months or more. And they can continue to print to get away with it. So yeah, I think it explains a lot why we're continuing to see gold go up right now, while the other metals, you look at the other white metals across the board, and you see a very similar movement to what we've had with the equities, with other industrials. Silver, platinum, palladium, palladium all taking big falls. Silver and platinum look almost identical over the last couple weeks. A big drop followed by breaking through about your 50% correction back up line, kind of sitting between the 50 and the 618 and trying to inch back up to where they started. But like I said last week, some of these other metals, even though gold is moving, the white metals really are still arguably bearish. They haven't given definitive signs, long-term definitive signs that we've pushed into bull market territory, which is something gold did a few years ago. Now you back the clock up 10 years, this is exactly what we saw 10 years ago. 2006, 7, and 8 leading into the market crash where gold had already started climbing. So we're seeing the same patterns play out over and over again, which I think is why we've been screaming from the rooftops, please look at silver, please look at platinum. It's really cheap right now when you look at those ratios that Robert brought up off the website. You can look at the silver to Dow ratio. You can look at the platinum to Dow ratio. You can look at the gold to Dow ratio and just say, how have these things moved over the last 40, 50, 100 years? And how can you make sure you're on the right side of that? So when the white metals do play catch up, you want to make sure that that's a part of your portfolio.
Yeah, for now, however, we're absorbing that deflationary cycle, right? We saw this in 2008 and 9 as well. And so you've got oil as a good example. Despite OPEC's cuts by 9, almost 10 million barrels a day, it really had little to no impact. In fact, oil's back down below $20 a barrel. So if anything, it sort of fizzled out in terms of its, potential impact. And you're now seeing that in the car prices. There's a huge concern now that you're getting a car price collapse. So initially, again, you're going to see some deflationary pressures. What gold is doing by building here is it's predicting, just like it's predicted over the last 4 years. People say, well, why has gold climbed? Why was it up 18% last year? Look, we've talked about it. It was baked in. We knew that an economic downturn was coming, too much debt, too much money printing. And so you're on the front end of this deal right now. You don't need to see the dollar down in the low 80s, which we will see again. You don't need to see inflation running rampant. The Federal Reserve is taking care of that, but anybody that's in gold now is ahead of that. Remember back in 2009 when gold went up $400 in that first year post-financial crisis onset. And that's what we're looking at here. And the prudent investor is getting in on the front end of this deal and not worrying about premiums of, a difference of 1 or 2% from a normal market. They're realizing, look, that's nothing in today's markets when gold is up 17% from the low that it put in 3 weeks ago, and silver's up 37% from the low a few weeks ago. The only other interesting point that I'd point out on the gold and silver is that ratio at about 110 to 1. All of that difference, you can look at the charts and it's reflected in the charts. Silver's having a hard time just even reaching its 50-day moving average, and gold is overshot by that same 10 percentage points and looking to come back down and touch that 50-day moving average. So if those two metals just do that in itself, that knocks you down to 100 to 1 ratio and you start to have that thing move against you. So again, I know we sound like a broken record, but continue to look at silver as undervalued gold right now.
Well, that does it this week for Golden Rule Radio. We appreciate you listening. Also listen to the McIlvaney Weekly Commentary. David's had some really good conversations there in the last few weeks, and you can click the link below.
So if you liked what you heard, you can click that subscribe button, ring the bell for notifications, head on over to Facebook at McIlvaney Financial, Twitter at ICA Gold, or give us a call anytime, 800-525-9556 to discuss your personal portfolio.
You can also head over to our website at McIlvaneyICA.com. We really appreciate you tuning in again this week. We hope you have a great week. See you next time.